If you're here, you're excited about dividend investing. And I mean, you should be. The idea of receiving passive income from world-class companies all over the world and being able to retire someday, it all sounds great. But how do we do it safely? And how do we know that the companies we invested in are going to be able to provide us with stable, safe dividend income for the rest of our life, so that when we step away from our job, we can retire securely? That's what we're going to discuss in today's video, and we're going to be looking at a key ratio that's going to help you figure that out and other ways you can analyze it to tell you more information about the company you're investing in. Hey, what's up, Internet? Mike the CPA here. So good to have you here. Thank you for joining me here on Money and Life TV, where we teach finances, investing, taxes, and more on a regular basis. So the focus of today's video, it's going to be all about the dividend payout ratio. The other thing it's called, or commonly referred to, is the payout ratio. That's what we're going to be talking about. Let's cover the definition of that right now. The dividend payout ratio is the ratio of total amount of dividends paid out to shareholders relative to the net income of the company. It is the percentage of earnings paid to the shareholders in dividends. The amount that is not paid to shareholders is retained by the company to pay off debt or reinvest in the core operations of their business. The payout range can vary from company to company. Some companies will pay out in terms of their earnings, because that's what we're really talking about here. When you receive a dividend, you're receiving a portion of a company's earnings. And based on how much of the dividend relative to the total earnings you're receiving determines the payout ratio. Starting from here, this is 0. This is a dividend payout of 0, all the way up to 100% or more. Depending upon the company, you may find their dividend payout ratio is very low. Typically, a low payout ratio would indicate a couple things. It could indicate the company's more stable. So if they're not paying out a lot of their earnings, what does that tell you as an investor? Well, it could tell you a couple things. First off, if I see a company that has a dividend payout ratio of 50% or less, which means they're paying out less than 50% of their earnings, annual earnings, to their shareholders, then I view that as a more secure dividend, because they still have extra cash, and with that extra cash, they're likely going to reinvest it in the operations of the business. And this is going to make more sense when we look at a few examples on screen here in just a second. I think what you need to know as an investor, when you see a low payout ratio, to me, that tells me, I've learned that means the company is still focusing more on growth. They don't want to give away all their cash to their shareholders through dividends. Why? Because, well, they want to expand their operations. They want to invent new products. They might need to do product development, product research, and things like that. That is why they might not be paying as much of their income to their shareholders. The lower, to me, and the way I've always viewed this, is the less they pay out to their shareholders, the more sustainable that dividend is. On the flip side, companies that pay their payout ratio, their dividend payout ratio is higher than 50%, we start to go from 50 to 100%, the less sustainable that dividend becomes in my eyes. Basically, let's say the company makes 100 grand in a year, just a simple example, and if their payout ratio is 80%, well, that means they're going to send out $80,000 of their net earnings for that year to their shareholders. And that could be a good or bad thing, because that means in that example, they would only have $20,000 left to keep the operations going, pay debt, reinvest in the company itself to grow the company further. The higher the dividend payout ratio, guys, the less sustainable that dividend is in the long run. Okay? Less sustainable. The lower it is, the more sustainable. And I think it does, if you look at the dividend payout ratio, which we're going to look at an example here in just a second, I think what you're going to see is that you're going to learn a lot about the company and their long-term strategy by viewing that payout ratio. A company with a higher payout ratio of 55 to 80%, what is that telling you as an investor? What does it tell you? Well, to me, it tells me that the company is likely an older company. That's why I wrote older up here, if you guys can see that. It means they're more established, like a Procter & Gamble, like an AT&T, a long-term blue chip stock. Coca-Cola is a really good example of that. Pepsi. Those are the kind of older companies I'm talking about that probably aren't going to be creating as many new products as a newer company over here that might not pay out a dividend at all to its shareholders. And what happens as a company gets more established, especially if they've been around 50 to 100 years, shareholders of that company, at some point, they're going to start to apply pressure to say, hey, I've been a shareholder for a long time. When do I start receiving some of the profits in the form of dividends? In fact, many companies have dividend payout policies. One, so they can appease the shareholders who want income, and secondly, so they can also try to appease the shareholders who actually want the company to grow and reinvest a portion of their earnings back into the operation and just raise their overall value of the shares, right? Because investors want both income and growth. So somewhere in between here, you're going to find the balance of income and growth. The more the payout ratio goes towards 100%, the more income focused it becomes. Now, can companies pay out more than 90% or 100% of their earnings? Yes, they can.
But Mike, why would a company do that? It's like having an income of $100,000, but your expenses are like $150,000.
That's right, Chipper. Does anybody know why a company might pay out more than 100% of its earnings in the form of dividends to their shareholders? Why would they do that? I mean, it's not good budgeting, right? Well, that's definitely not sustainable, for one thing, unless the company has a lot of cash reserves, unless they might be financing it through debt, which, as an investor, I don't want to see that. I'd rather have less dividend and have a dividend that's more stable in the long run, but that's me. But companies, like I said just a few minutes ago, are under pressure to perform, especially if they're a long-term blue chip company like a Procter & Gamble. If you look at Procter & Gamble's dividend payout ratio, it's around 200% right now, which means it's paying out twice the amount of its earnings in the form of dividends to their shareholders. I don't think that's going to be sustainable in the long run, but we would want to look in that situation, we'd want to see what kind of cash reserves does Procter & Gamble have. Also, are they taking on more debt to finance these dividends? So we'd want to look a little bit deeper into it if we saw that was the case. And right now, that is the case for Procter & Gamble. A lot of these blue chip companies that have been around for a while do have a lot of pressure to keep increasing their dividends, especially if they have a track record, of doing so. Because if you, as an investor, if you see that a company has raised their dividends for like 25 years straight, what are you expecting? What do you think is going to happen the next year? Well, as an investor, I think you're going to think they're going to raise it a little bit the next year. So I think that's part of the issue with that. But you have to look deeper at the financials if that is the case to see why are they paying out more than their earnings? And does this look like a trend that's going to reverse itself in the coming years? As an investor, you want to look at those things. So is their top line revenue decreasing? What's going on with their net income? Do they have special one-time deductions this year for tax purposes that is driving their earnings per share down? Or what's the deal? So there's additional analysis you'll want to look into if you find out the dividend payout ratio is rather high, like 75% or above. I want to know why it's so high before I dive into that investment as an investor. Okay guys, to calculate the dividend payout ratio of a company, you can do this in like 10 seconds. It's really easy. As you're seeing on screen, Apple has a dividend payout per share of $3.08. As a shareholder, for every one share of Apple, you can expect $3.08 of a dividend. They also had earnings of $11.78. So to find or calculate the dividend payout ratio, all you do is you take 3.08 and you divide it by 11.78. And you can see Apple's dividend payout ratio is rather low at 26%. If you look at Microsoft, because I compared it to Microsoft, because they're similar companies, I wanted to see what theirs was. Well, Microsoft is in the 30s. I think it's around 35% the last time I looked. So as you're looking at companies, especially if you're considering one company over the other, if they're related, like Coke versus Pepsi, like AT&T versus Verizon, Microsoft versus Apple, compare their dividend payout ratios and you can see you can get a sense for what their overall strategy is. Now Apple, with a dividend payout of only 26%, I think that company still wants to grow. I think they still want to find ways to be innovative if they can, and keep growing their operations. But if we see Apple raise their dividend over time to a larger and larger percentage of their earnings, well then I think that their innovation might be stalling as an investor, and that's why they're trying to please their shareholders, because they haven't figured out a better way to use their extra money with their earnings. They haven't figured out how they're going to grow the company or make a new groundbreaking product, and hopefully they can do so going forward, right? In a nutshell, that's how I view the dividend payout ratio. And you're going to have, I think what you're going to find is you're going to have some investments in your portfolio that they're still good investments, but their payout ratio is rather high. They might be like the 75% range, 80% range, and it's not the end of the world if that's the case. But what you want to look for is look a couple of years down the road and see if their dividend payout ratio is improving. And if it's not, you have to be skeptical if that dividend is going to be able to stay at the amount it is. They might have to cut it back. And when they cut it back, shareholder confidence, especially if it's a company, let's say like a Procter & Gamble who's been raising their dividends for a long, long time, well then as a shareholder, your confidence might be shaken a little bit. So if they cut their dividend a little bit, you might see their share price drop as well. Now that's just my thoughts. I can't prove that, but I think that's what would happen because a lowering dividend might indicate a sign of weakness in the company or their earnings. Those are things to look at, guys, when you're trying to find safe dividends. The dividend payout ratio is not only going to tell you how sustainable your dividend is with that company, but it's going to give you an indication of what the company's plans are going forward. But I always encourage you, this is just one metric, the dividend payout ratio. Look at the financials, read up on the company, figure out what else is going on. Do they have a lot of cash? Are they taking on debt? What is the company doing? What's their overall financial health? As a long-term investor and not a day trader or swing trader, you're really interested in the fundamentals of the company more so than the daily ups and downs of the market on the charts, because you want to know if your income is secure. And by doing this process, by looking at your companies that you own this way, you're going to get a much better sense of how reliable that dividend might be well into the future. So when you do step away from your job or whatever it is that you guys do, that you can retire comfortably, knowing that you have a whole portfolio, a diversified portfolio of nice dividend-paying companies that you can rest peacefully at night, knowing your passive income is going to keep coming in day after day, week after week, night after night. Alright guys, well that's all the information I have for you in today's video. Thanks so much for hanging out with me here on YouTube. Drop a like before you leave, comment below, let me know what other things you look at, even besides the dividend payout ratio, to keep your dividend income safe so that you know that your passive income is secure. Because we want to make sure we are, as investors, we're investing our money in safe places so that it keeps returning more and more to us each and every year. Now if you're new to Money in Life TV, I just want to say welcome. On this channel, we're all about helping you become fiscally fit as we teach finances, investing, taxes, and more on a weekly basis. So don't forget to subscribe if you have not done so already. You can do so by hitting the red subscribe button down below. And if you hit that little bell notification icon, it will notify you every time I release new content on the channel. I will be engaging with you in the comments below, and so that's where I'll see you. I hope you all have a great week. Take care. And use this information to live your life uncaged. Bye guys. Peace.